To our Mardi Gras celebration. Actually, you might not be expecting that, but we're here to talk about consumer financial protection, which I think is what you're here to listen to and participate in. My name is Reed Kramer. I direct the asset building program here at the New America Foundation, and this is a program that is exploring innovative ways to promote social development and economic opportunity, especially promoting, helping people save and build up assets over time. So accordingly, we're very concerned, we've been very concerned about the proliferation of abusive financial practices that have come about in recent years. These are practices that make the asset building process harder for many people, and they've also played a role in the debilitating economic crisis that's unfolded in recent months. We've been very concerned for a long time about improving access to high quality and low cost financial services, and this is because these are the resources that people need to manage their lives, and it becomes a real important component of pursuing paths to economic security. So these are long-standing concerns of mine, of our program, and they've really been given new urgency by the economic crisis that we're experiencing, that we continue to experience, and that's impacting the lives of millions of American families. So there have been calls to address the rules of the financial sector, proposals to create a new and independent consumer financial protection agency, and advocates have argued that we need a new regulatory regime that is going to take the interests of consumers in mind and not just banks. So now the issue is, what does this mean in practice? And we've seen that in recent years, the landscape for consumer financial services has evolved so that a suite of products have been offered that are often inappropriately sold to people who don't understand their basic terms. They don't need them, and it's had unfortunate consequences. This applies to credit cards, payday loans, check cashing, mortgages, and other products. So at a minimum, there's a need for new mechanisms to be put in place that help identify and stop these kinds of practices. Now, there have been other voices that have entered the debate that highlight the issues of undue regulatory burden, that highlight the issues of potential contraction of responsible credit, and also displacing the primary goal of bank supervision, which is looking at the balance sheet, a healthy balance sheet, safety and soundness issues. So these are the kind of things that have entered into the debate recently. There's been a lot of heat. We're here today to try to shed some light on these topics. And we're releasing a background paper on some of the issues of the Consumer Financial Protection Agency that's in your packet today. And the paper kind of considers what are some of the issues that are at stake in the current debate. But that's what we're here to dig into these issues at this event today. Now, deliberations are actually unfolding in real time in Congress right now. So actually, I've been promised to get tweets during the session today. If there are really flashing news flash updates, I'll pass them along. But really, the general context is that the House has already passed a very sweeping financial reform bill that included creating a new and independent consumer protection agency. It was in Title IV of the Wall Street Reform and Consumer Protection Act. It passed in December along largely partisan lines, and I mean, it had no Republican votes. That would be partisan. So anyway, the focus now is in the Senate. And Chris Dodd is overseeing the process. He's pledged to push reform through before he retires at the end of the year. So we've assembled a panel of experts to really help us assess whether this debate and this policy process is on the right track, and also to better understand some of the issues at stake with the relationship between consumer protection, with access to financial services and with bank safety and soundness issues. So the bios of the experts are in your packet. It's a pretty impressive group, as you'll see. We're going to focus this discussion with two panels. The first is going to look at some policy issues, and there we're going to hear from Travis Plunkett, who's legislative director at the Consumer Federation of America. Julia Gordon is senior policy counsel at the Center for Responsible Lending, and Tim Fernholz is staff writer at the American Prospect, who's been doing some real excellent reporting on this area for that magazine. The second panel will be moderated by my colleague Ellen Seidman, and it's going to focus on perspectives of regulators and also state and local authorities. So Ellen, she's a senior fellow here at the New America Foundation. Formerly, she was director of the Office of Thrift Supervision during the Clinton administration, one of the federal bank regulators. And she brings a lot to this discussion. And then we're going to hear from Jonathan Mintz, who's Commissioner of Consumer Affairs for the City of New York in the Bloomberg administration. This is a very innovative and active office. Jonathan's involved in a lot of great works, but has an oversight of the consumer services in the city of New York. So he's got a perspective on this as well. Then we're going to hear from Sarah Bloom Raskin, who is the Maryland Commissioner of Financial Regulation. So she brings her perspective from the state level. She's also been chairing a task force of her counterparts in other state agencies. And we're going to look forward to hearing her perspective and also what this task force has come up with. So before we kind of go into this first panel, I just want to note that there really are a lot of moving pieces to the financial reform discussion. And it actually makes it quite hard to track. I mean, the consumer protection discussion is one piece of it, but it's a very fluid and evolving policy debate. You know, we do know that the banking industry and the U.S. Chamber of Commerce have come out against the administration's reform proposals. They've specifically identified the CFPA is something that they're not in favor of in its current form. And, you know, these are interests that don't have a problem getting their calls returned when they call up to the Hill or having meetings on Capitol Hill. That makes it challenging sometimes to get a reform package through. I thought a few months ago that regardless of their opposition, something had to happen. Just given the events of the last year, we were going to see a reform package moved through, and that doing nothing was not really an option. Now, I think it's a lot more uncertainty is in the air. We don't know if the U.S. Senate is going to ever pass another piece of consequential legislation ever again. So that includes this piece of legislation as well as other ones as well. So a lot of uncertainty is in the air. But I think we do know that if the rules don't change, irresponsible behavior won't be deterred. Consumers are going to remain exposed, and there's no guarantees that what we've just gone through won't play out again in a new way at a different time. And that's very problematic. So to offer a couple other comments of a basis for this discussion, I did want to highlight a couple of policy issues that I think are going to come up today. You know, one is the oversight of non-bank providers. This is the alternative banking sector, and we need to create some avenues for greater scrutiny of this sector. This is where many people often access their financial services, often at terms that are quite poor, and it's largely unsupervised, especially by federal regulators. And these are all the, subprime mortgage, payday lenders, money transmitters, check cashers, the whole array. So it's high time that they're brought under some kind of common supervision. And consumers shouldn't have to access different levels of protection depending upon what provider is providing their service. That should be one of the principles that we build from. Another is just the extent of rulemaking and enforcement mechanisms that are in play. If we create a new authority, will it have the power to enforce its mission? When it sees practices that go over the line, will it be able to stop them adequately? A third is the broad issue of the relationship between regulators and between state and local authorities. We're going to hear a lot about this today, as I mentioned in the second panel. It's been an issue in recent years when some of the states have had higher standards than the federal government, but federal standards then ended up preempting the state rules, and so we need to keep an eye out for what some of these regulatory pitfalls are that need to be navigated. And finally, there's just a broad issue of a new agency's impact on cost, access, and innovation. So there's many issues to consider, but I think we need to keep in mind that given the nature of the economy, all families need access to a basic array of financial services that they can use to navigate their lives. And it's a foundation of economic security, and it's essential for enabling people to seize the opportunities as they arise. Now, the final point before turning it over to Travis is that the current rules that we have often create a safe haven for firms that are peddling products if they bury the terms in the fine print. And we know from experience that there are real limits to this disclosure approach, especially as far as the consumers are concerned. People get overwhelmed by complexity. Lawyers make sure that they're written in ways that people can't understand them, and it's a real problem. People shouldn't be tricked into products that they don't need or understand. And instead, we need to articulate a set of principles that govern future product offerings. And these principles are transparency, accountability, fairness, and simplicity. And I think this would be very productive if we transition from this rules-based regime that we have to a more principles-based framework. It would represent a real paradigm shift that might help restore integrity and trust back into the banking system, the financial services system. This used to be the foundation of this system, and perhaps a new agency that highlights consumer protections would be a means of bringing these values back in to the marketplace. And I think that's the potential of this discussion. That's the potential for what's at stake in this discussion. So that's kind of the design of some of the foundations to consider. And I'm going to have Travis come up and offer his remarks, and then we're going to hear from Julia and Tim, and then take questions from you as well.
Thank you. It's great to be here. Thank you, Reed. I'd like to take the brief amount of time that I have right now to focus on what is turning out to be the central question in the debate over improving consumer protection regulation in Congress. As Reed mentioned, the House has passed legislation. Part of that legislation would set up an independent, autonomous consumer financial protection agency. Over on the Senate side, though, that idea, the idea that we should have an independent entity, as we do with the Consumer Product Safety Commission, focused on protecting consumers in the financial marketplace, is running into stiff opposition. The concept is actually running into stiff opposition. The idea that there should be an independent agency focused on consumer protection is opposed by, for example, Senator Shelby, a key member of the Senate Banking Committee, the ranking member of that committee, and others. Senator Gregg of New Hampshire last week said that he and his caucus would not support an agency that did not subordinate consumer protection regulation to safety and soundness regulation. And for those of you that know financial regulation well, you know that that is pretty much the case right now, that the 5 banking agencies have multiple responsibilities. 2 of the major responsibilities are to protect the safety and soundness of the institutions they regulate, and also to protect consumers. Senator Bennett, another key member of the Senate Banking Committee, has gone further and said that a standalone agency focused on protecting consumers, in his mind, will replicate the Environmental Protection Agency. That it will be too aggressive, in other words, in protecting consumers, and that might harm the regulated banks and hopefully regulated non-banks. So what I'd like to do very quickly is re-examine the failures, the regulatory failures that have occurred, touch on the reasons for those failures from our analysis, and then talk about the ultimate solution here as we see it. So just to revisit the parade of horribles for you, it wasn't just subprime mortgage lending that was a problem. And I think it's fairly well known by now that the federal regulators had the ability in a number of ways, but especially through rule writing, to rein in subprime mortgage lending abuses by both non-banks and banks as well. The Federal Reserve did have authority that it didn't use for 14 years to deal with subprime lending abuses by non-banks. Wasn't just mortgage lending, though. Credit card lending credit card debt approached $1 trillion by the time that losses for credit card issuers and also borrowers, we should remember, started shooting through the roof. The charge-off rate now, this is the amount of debt that has gone bad proportionate to the amount of credit card loans that are being offered, is now at its highest level ever by a long shot. It's over 10%. 3 years ago, we talked about 5% charge-offs as of great concern, as an indication of, in some cases, bad underwriting by lenders and bad choices by borrowers who are being offered loans that looked far more attractive than they actually were. So for 15 years, CFPA and other organizations warned about shaky underwriting on the credit card lending front, and especially about deceptive and unfair practices. It wasn't until 2008 that the Federal Reserve proposed rules there as well. Overdraft loan practices, much in the news these days. These are loans that are offered often without consumer request, often without their knowledge. They are encouraged to overdraw their accounts and then are charged very high sums to cover that overdraft. The Federal Reserve finally, late last year, offered rules. Congress is likely to go further. They have proposed rules that not only offer consumers a real choice, an opt-in opportunity to say, I do or I don't want overdraft loans, but would also curb the number of fees that that banks can charge for overdraft loans. Federal regulators played some significant roles in other forms of abusive lending too, including early on in this century, fueling the rise of payday lending by not reining in arrangements between chartered banks and payday loan operators. We call this rent-a-bank payday lending. All of these failures had a number of similarities. One of the big similarities was that the regulators didn't act until Congress got interested in reform. In almost every case that I just ticked off, it wasn't until Chairman Barney Frank, for example, threatened to the Federal Reserve that they should use their rulemaking authority to rein in unfair and deceptive acts and practices or lose it, that the Federal Reserve started to get serious about subprime mortgage lending abuses and credit card abuses. And it wasn't until credit card legislation was introduced on the House side that the Fed got concerned as well. So why has this happened? The prime reason in our mind is not structure. It's a failure of will. It's a regulatory philosophy of market fundamentalism, that it was dangerous to rein in lending for lenders, that it would impinge on the choices that were offered to borrowers, that it would limit access to credit, and as we've seen, bad regulation, under-regulation, can have many of the same effects that regulators worried about with over-regulation. For example, in the credit card marketplace, before Congress enacted a new law, credit was drying up, credit lines were being cut back, arbitrary decisions were being made by lenders regarding who got credit and who didn't. Many of the same concerns that we hear about regarding overregulation were occurring because of bad regulation. So, why? One, nobody had consumer protection as a priority. We have close to 20 consumer protection statutes. 7 agencies share the authority. When the authority is not vested with a single agency, it's really not vested with any agency. It fell through the cracks. Secondly, conflicts of interest. The Office of the Comptroller of the Currency and the Office of Thrift Supervision, in particular, had huge conflicts. They are almost entirely funded by the industries they regulate. As we've learned the hard way, regulated thrifts and national banks could charter shop. They could move from agency to agency. They could take that funding with them. It put pressure on these agencies to lower standards, and in some cases they did. The classic example being OTS, offering to Countrywide to go a little easy on some forms of their subprime mortgage lending if they move from the OCC to the OTS. Okay. Final reason, which is what I want to finish with, is what happens when you have prudential regulation and consumer protection regulation housed at the same agencies. In theory, one should benefit the other if it's properly done. I mean, we've learned the hard way that subprime mortgage lending has harmed the safety and soundness of many of the institutions and non-bank entities that offer them. I mean, many of those entities don't exist anymore. Had regulators paid greater attention to consumer protection, to the underwriting and the ability to repay those loans, then some of these entities might still be around. And also, good prudential regulation can benefit consumers. So that's the theory, and that's true. But what's also true is these two missions can conflict, seriously conflict. When you think about it, they're quite different. Protecting the safety and soundness of an institution requires different approaches, different methods than protecting consumers in the marketplace. A business conduct regulator has to be completely transparent, has to tell the public what the problems are, has to publicly enforce the laws. A prudential regulator, more collaborative, work with the regulated institution behind the scenes, worry about safety and soundness, take behind-the-scenes approaches to improve the safety and soundness. That kind of approach is more justifiable when it comes to safety and soundness. It is not at all justifiable when it comes to protecting consumers. So we have a fundamental problem here often in the approaches and the goals of these regulators. And back to Congress, what we're hearing from Congress is that's okay. In some cases, we would prefer that the safety and soundness assumes a more significant role than consumer protection. And that would be a huge mistake to go that route. It would mean that we haven't learned the lessons of the crisis. It would mean that we haven't learned the lessons of other agencies as well. For example, the Federal Aviation Administration no longer has as its mission promoting the welfare of the airline industry. It's a conflict. It would be like putting the Department of Commerce in charge of the EPA because you're worried about the underlying economics of the industry. We need to separate these functions, but we need to require the two regulators to talk, to coordinate, because on occasion there will be conflicts. For us, that's the way to move forward. You have a separate agency, but you require that agency to coordinate closely with the prudential regulators, and you make sure the prudential regulators don't have veto power over what the consumer agency does. Thank you.
Great. Thank you.
Hi, thanks so much for inviting the Center for Responsible Lending to be part of this discussion. For those of you not familiar with the Center for Responsible Lending, we're the research and policy affiliate of the Center for Community Self-Help, which is a community development financial institution. We make mortgage loans to low-wealth families. We do some small business lending and neighborhood revitalization. We run a secondary market program that facilitates other lenders lending to lower-income communities. And we also operate retail credit unions in both North Carolina and California. And the reason I say that is because among our affiliates are entities subject to both state and federal regulation. So when the Center for Responsible Lending looks at these issues from a policy point of view, we have to consider the compliance costs and regulatory burden the same as any other financial services provider. And in our view, we don't consider any proposal to establish an independent consumer financial protection agency to impose any kind of unfair or significant burden on us. In fact, quite the contrary. Because we have engaged in responsible lending for so long, we consider any effort to provide additional fairness to consumers something that will assist us as a financial institution. It levels the playing field so that we're not competing against institutions that are engaging in tricks and traps and other unfair ways of luring consumers into products that aren't suitable for them. So that's our background. I'm going to try to keep it short because we want to talk about questions, and Travis has already gone through a lot of the information about how the regulators fell down on the job in the past couple decades. But I'd like to talk a little bit more about Travis's point concerning the conflict or potential conflict between consumer protection and safety and soundness, the prudential regulation. In our view, over the long term, there's not an inherent conflict between protecting a consumer and ensuring a safe and sustainable banking system. In fact, if there's nothing else that we've learned from the current crisis, it's that ignoring the needs of consumers and fairness to consumers ultimately can significantly impair the safety and soundness of the entire system, and in fact, as it has in this case, threaten the larger economy. In the short-term sense, when safety and soundness is largely equated with short-term profitability, there will sometimes appear to be a conflict between protecting the consumer and essentially getting as much money out of that consumer as possible. And I think Travis has accurately outlined the dynamics within the current regulators such that consumer protection there has been really ghettoized and devalued. And generally right now, when there is a conflict, when the question is whose money is more important to protect, the bank's money or your money, generally the conflict's resolved in favor of the bank's money. And what's interesting to me is that listening to this debate on Capitol Hill, you find so many members of Congress willing to just admit that, willing to admit that it is always more important to protect the financial service industry's profitability than to protect you, the consumer, from spending bad money or not permitting you to save money as best as you can. I also want to make one other comment before we turn to the next presenter and get to questions, which is a comment on how the terms of this debate have been set. In many ways, the terms of debate themselves have been set by the financial services industry. Right now, I think everybody in this room probably knows at this point that that an independent, freestanding consumer agency may well not be in the works, despite the bill that passed the House of Representatives. And there's a great debate right now about how you will ensure that disputes between prudential regulators and consumer protection regulators will be mediated. And the mere fact that the discussion has moved to that place assumes things to be facts that, in our view, are not necessarily accurate facts. Some other parts of the debate, the talk of stifling innovation or limiting access to credit. There are questions that need to be asked that I hope folks can help ask better. Innovation for whom? Many of the so-called innovations of the past decade have been innovations that permit financial institutions to do a better job of selling bad products to consumers who don't have the knowledge or don't have the ability to see what they're getting into. Access to credit for what? The area I work most in is the area of mortgages. And something I often talk about is that we're interested in promoting home ownership. We're not interested in promoting home buyership. And that's really what was promoted by a lot of these products that were being offered on the market. So, access to credit is useful when it enables a family to increase their wealth, to increase their assets, to put their family in a better position than they would have been otherwise, when it permits them to invest in education, in a home, in other things that a family needs, not just access to credit for the purpose of paying interest and ultimately paying penalty fees when walking into any of these so-called tricks and traps. So ultimately, the bottom line is it is desperately important that we get an agency solely focused on rigorous consumer protection. In fact, it will be quite stunning if we are able to come out of what just happened over the past few years without some kind of regulation of that nature, and it would really be a comment on the intense undue influence that the financial sector and their lobbyists have on our decision makers. So thanks so much for inviting me, and I look forward to your questions.
Great, thanks. Tim.
Hello, everybody. Thanks to the New America Foundation and to Reed for setting this up. Julia and Travis have really gotten into a lot of the big picture stuff about why we need better consumer financial protection, but I'm afraid I may have to be something of a skunk at the party and sort of explain why we're talking about this debate is going to be a little bit disappointing, and unfortunately I think you may be stunned by the results of the legislation that's in the Senate right now. I think a good analogy for the Consumer Financial Protection Agency as a centerpiece of the overall financial regulatory reform plan is to the public option in healthcare reform. You sort of have a Jacob Hacker figure in Elizabeth Warren who sort of promoted this idea for a while, but you don't have sort of the history of understanding this policy broadly through electoral campaigns. No one has really talked about these issues as a centerpiece of something until really the crisis hit in 2008, despite a long history of people at CRL or at the CFPA have been working on this for a while. And so we do have a debate that really has been set up by the financial industry, as Julia said. And right now in the Senate, unfortunately, it seems like an independent agency may very well be off the table. The compromise that may be most effective that Senator Dodd and Senator Corker of South Carolina are talking about right now is hosting an agency within Treasury, a la the FDA, which is part of the Health and Human Services Administration, or the OCC, which is within Treasury. And it would be interesting to discuss if the head of that office were appointed independently, whether that could be somewhat effective. Talking about the relationship between safety and soundness, prudential regulation, and consumer protection, I think both the previous speakers were exactly right that there is a conflict there, and the key is having an office that really does mandate that as the top priority. But some of the areas where the office could have trouble working out its mandate are places where different private interests have sort of lobbied for problems. So if you look at the House bill, one thing you see is there's an exemption for small banks. Banks that have less than $10 billion in assets aren't going to be able to be inspected by the CFPA. And I think the House bill provides a real model for the compromises we'll see in the Senate version. And so that's going to allow only maybe 80 banks to be directly inspected by a potential CFPA. And so that debate is going to be at the heart of this, whether small banks like the bank that Julia's organization has are going to be able to sort of separate themselves out from the regulatory regime that they're trying to create, or whether they'll be a part of it. Another thing that I think we'll get into in the next panel is going to be talking about federal preemption. Right now, the standards that apply really keep state attorney generals, state consumer regulators sort of off the playing field. And that's one of the reasons why Citigroup went to the OCC when it did, was because they knew they were going to be able to escape a lot of local scrutiny of what they were doing. The compromise in the House bill goes back to an earlier standard that would allow less federal preemption, but not as much as reformers wanted. So it's going to be hard to see if the Senate can really keep that middle ground or if it's going to go back to more preemption. The other question that exists is, as part of the broader regulatory overhaul package, whether the new banking regulator that will possibly be created is going to be as captured by the industry, as likely to give in to their demands for preemption and other sort of lax rules. And the other thing to look at is industry exemptions. One of the big failures in the House bill going forward is that auto loans from dealers are exempt from regulation by the CFPA. So people are already talking about potential for securitizing those loans. People are talking about how those loans, as we see with all kinds of regulatory arbitrage, bad practices migrate to areas where there's not as much attention. And so looking for specific industry exemptions is going to be a big part of going forward on making sure that whatever comes out of Congress actually is effective at all. But it is interesting to see that people, while the financial sector is willing to admit, is really opposing this, are also willing to admit a need for this. Lloyd Blankfein, the CEO of Goldman Sachs, was testifying recently at the Financial Crisis Inquiry Commission hearing, and he was really getting browbeaten by commissioners about the quality of the securitized loans that they sold, not really looking at the underwriting standards of so-called toxic assets that were sold. And Blankfein admitted that, look, maybe what is needed is someone at the ground level to make sure these loans are not going to be toxic loans, subprime loans, no income, no asset loans that are almost guaranteed to blow up in people's faces. So I think where reformers, people who are interested in seeing a real change, need to focus right now is really on the details of these bills, because I think the political realities really do suggest that it's going to be hard to get an independent agency, as much as that would be the ideal situation. And so moving it forward, we need to focus on where things can be improved. And Travis mentioned how the action in Congress prompted the Fed to do some regulatory efforts, however halfway they may have been. And if we can come out with a system where overdraft fees are better regulated, where credit cards are easier to understand, we'll also have a better consumer credit market. Because when people, especially the financial industry right now, talk about how this regulation is going to disrupt the free market of consumer credit, that market doesn't really exist because consumers really don't have the wherewithal to compare different products. They can't understand. Elizabeth Warren has a joke that she gives her law students credit card and mortgage contracts, and they can't understand them. And so if you can't compare those products, it's not a free market at all. So despite claims that the cost of credit is going to go up because of potential regulations here, I think Adam Levitin at Georgetown Law has sort of debunked some of the arguments there that really we don't know yet if the cost of credit is going to go up, but by making this market have more information, it's not likely to hurt access, especially when you look at statistics from New York where you see real redlining practices where subprime loans were really targeted towards low-income African American and Latino communities at rates of 5 to 1 compared to similar income status white families. So I think access here is only going to be improved by the CFPA. And I think the last thing I would mention is that a lot of the rhetoric around this bill has really been almost Orwellian. People have talked about a memo released by a conservative strategist named Frank Luntz that almost flips this debate on its head. They talk about how the CFPA is going to be creating a big government bureaucracy when in reality it is consolidating 7 separate institutions, something like 17 different regulatory statutes into one piece of legislation. So I think if reformers, if we really want to see a better consumer credit system, we really need to focus on where we can move this argument and some of the real specific policy things, because it is, I think, a losing battle right now. Thanks.
Thank you.
Actually, that Lutz commercial was also framed as a bank bailout, that this bill is going to be a huge bailout. Anyway, let's I want to invite everybody to kind of think of some of their questions for the panelists, and we'll have a mic that moves around, and you're going to identify yourself and where you come from, and state your question very concisely when that mic does get to you. So, but let me maybe start with some of the issues that Tim actually almost posed to Julia and Travis to begin with. One was this alternative structure. I mean, what are some of the trade-offs with an alternative structure opposed to a kind of an independent agency, what could work, what could be productive within that confine?
So the idea here, I think, is that you replicate the Office of the Comptroller of the Currency as a mostly autonomous agency under the Secretary of Treasury, within the Department of Treasury. And I think the answer to the question is it depends how much authority prudential regulators, let's say a merged national bank regulator, which might include the OCC and the OTS, how much authority that agency would have, not to communicate to the consumer agency, not to consult with, but over their decisions. Because for the consumer community, it is a step backwards. It is literally worse than the status quo to give prudential regulators veto power or significant authority to stop consumer protection decisions. That's what happened before. That's the status quo. Having a more powerful, enlarged, emboldened agency with that authority would actually be worse than the status quo.
Well, just to add a few more details, the OCC, for example, under Treasury, is guaranteed independence by a number of characteristics of how the agency is set up. It has 5-year presidential appointments of an administrator. There's independent funding. They have autonomy in rulemaking and enforcement. And so all of those types of characteristics would be crucial in order for an agency within Treasury to be able to operate to protect consumers as is necessary. If the Secretary of the Treasury, for example, had some kind of tiebreaker vote over the consumer protection rules, that leaves consumer protection in the same backseat that it's in now.
Okay, well, let me know if you have a question out there, and Mark will give you the microphone. Why don't we start right there?
Oh, hi. My question is about the broader financial regulation package. I wonder if you could comment on how likely you think that is to pass, any packages to pass this year. And I ask that because clearly the next chairman of the Senate Banking Committee will be less of an advocate for consumer protections than Chris Dodd is, whether it's Tim Johnson or a Republican, we'll see. But clearly he'll, like I said, less of an advocate for consumer protections, and so...
So you want the whole package, the broader financial reform package get through?
Exactly. There will be some kind of legislation that passes that will be called financial regulatory reform. That's a major campaign point for the Democrats. The White House has been pushing it. But the real question is whether financial regulatory reform will actually have teeth, whether it will do something, or whether it's going to be a cosmetic bill that's sort of for political purposes only. And right now it really is all on Chairman Dodd's head, and he's been in negotiations. First they stalled with Senator Shelby, now they're going on with Bob Corker. And unfortunately, I think the real issue of disagreement between the Democrats and the Republicans is the Consumer Financial Protection Agency. That's where you hear a lot of the differences. There have been some agreements on issues like resolution authority, capital and liquidity requirements, things of that nature that maybe could pass, that could be good reforms, but the question is whether that's going to come at the cost of a sort of cosmetic consumer agency.
Let me give you just a couple of quick flashpoints to look for in determining whether the full package is meaningful or not, at least from the consumer point of view. So aside from the question of consumer financial regulation, the question of derivatives regulation is proving to be a flashpoint. This is another area where the big banks are having enormous influence. Key question, how much of the derivatives market will be centrally cleared, and on central clearing, what kind of exceptions to that will exist? There's a very large exception in the House-passed bill. And will the majority of derivatives transactions actually be transparent and open to public view? Next flashpoint, story in the New York Times today about the investor protection provisions of this package. Will there be transparency in terms of the different kinds of broker-dealers and fiduciaries that exist in selling securities to small investors, and will there in fact be a true fiduciary duty that is binding and meaningful placed on all who sell securities to small investors? That's under attack. Senator Johnson from South Dakota says he wants to do a study. SEC recently did a study on this issue. So it looks like a clear attempt to punt on this crucial issue.
Okay. Question here.
I want to take the discussion a little bit broader, even beyond the U.S. I've just come back from Kenya doing a financial consumer protection diagnostic there for the government. And what happens here has a lot at stake for how regulators around the world perceive it. And I want to suggest, I think there might actually be some opportunity to look at models that are working in emerging markets that have relevance here, where in South Africa, for example, they created a national credit regulator. The coordination with the central bank and the other regulators within Treasury is working, and the sky didn't fall in terms of access. Other examples actually have market conduct regulation being effectively enforced within a prudential regulator. I would point to Peru as an example of that, and Malaysia. So I think actually broadening the discussion a bit and looking at some models where instead of just will it work, won't it work, and then it's all ideology, to actually point to some examples where, yep, we see MOUs, we see arrangements, we see work proceeding on both fronts and more synergies than trade-offs. And I think that's one of the key messages maybe to bring out.
Okay, thank you.
Australia is one country that Hank Paulson, the former Treasury Secretary, recommended a separate business conduct regulator based on the Australian model, for example, of prudential regulation, consumer regulation, and lots of coordination.
This isn't sort of a direct model, but I think there's an analogy to be made with microloans, which have been very talked about in the past couple of years in the developing world, where people saw communities that they said, look, you can't give loans to these people, you're not going to get paid back, they're not going to be sustainable. But it turns out that when you do that and you provide the right incentives, you see people who are using those loans to build their economies and are paying them back. And the same thing sort of happens in the United States, where people will make the argument that, look, payday lenders are necessary to the economy because people can't get loans elsewhere. But the fact of the matter is that there are sustainable loans that are available. They're just driven out of the market by sort of these bad business practices. So I think it's just important to remember that, you know, sustainable credit is available for people with low incomes, and it's a matter of creating policies that make that possible.
Yeah, I think there is promise in looking at other models. And when I mentioned before about looking at the foundation of a principles-based regime as opposed to one based on disclosure, I think that is very compelling. Let's see, Greg?
Yeah, I have a too big to fail or too big to jail question. A number of economists, Joseph Stiglitz, Paul Volcker, have suggested that, yeah, we need to change the way these guys do business, but what we really need to do is break them up, or not allow institutions to become so large that their failure could threaten the system. Today, Henry Paulson has written an op-ed which he says we need to find a way to liquidate these institutions so that they don't threaten the system and they don't require taxpayer bailout. I guess I'd like to ask if anybody in the panel sees any scenario where we may actually reduce the concentration of large institutions in this industry. Or is that just utopian thinking?
Well, I'd like to point to Mark Cooper, our research director, who's been over here frequently, who's written on this, is actually a study on CFA's website on financial regulation and regulatory fundamentalism. And what we've said publicly is that good prudential regulation can also achieve that goal. You ratchet up capital standards, you ratchet up requirements on institutions, and they don't get too big to fail in the first place. Regarding the prospects, it's hard to call right now, but given, once again, the battle on the Senate side, it's not looking like the Republicans are going to embrace that approach.
Yeah, on the end there.
One of the things that I've been hearing as a possible compromise idea is something similar to the Walt Minnick approach under consideration that narrowly failed in the House. This would be a Consumer Financial Protection Council that would coordinate among the prudential bank regulators in terms of rules for consumer protection. And I guess I just wanted to get your sense of possible problems you guys might have with that approach.
Well, I can respond, and Julia may have something to say here too. So this is, you've got it exactly right. This is a council of regulators. You don't create a new regulator. You create a council. Looks like 12 agencies. They're going to actually, under the bill, bring in new agencies who don't really have much to say about consumer protection in the credit area, like the SEC and the CFTC. They're going to be on the council. What about the states? What about non-banks? Well, big problem here. In order for for the council to address any issue related to a state-regulated non-bank, a separate state representative has to go out and get half of the 50 states to agree to that recommendation before they can even bring it to the council. So from our point of view, it has a number of flaws. It keeps the same regulators who failed largely in place. It creates a new level of bureaucracy without really creating a new level of commitment to consumer protection. It's sort of the worst of all approaches.
Well, I mean, right now there are three words that strike fear into the heart of both consumer advocates and regulators, which is joint rulemaking authority. It does not work well. It has not worked well. And there is no reason to believe that a council of this nature would not be subject to the exact same race to the bottom that we've had so far in terms of, the basic charter arbitrage problem we've been facing. For the strength of this agency, for the strength of any agency, our view is that you will need to have an administrator, you will need to have a dedicated staff. Rulemaking needs to be data and evidence-based. We need to be able to independently collect and analyze the information, and also to have concurrent enforcement authority along with both the other federal regulators and with the states.
A related question is the relationship between examinations and kind of enforcement rules. You didn't mention examinations in that. Tim described how the House bill had large exemptions from examination, but not from rule compliance for smaller banks and credit unions. Is that a problem? Could you do this on those terms without examination at all, but just with kind of enforcement mechanisms?
Well, we're not in favor of the exemptions, that were imposed on the House bill. As the agency needs the authority to collect and evaluate data. There are ways you could come up with to do that wouldn't be direct examination authority. That would be cumbersome and possibly not as effective. But the importance is being able to have the access to the same data that the other regulators have in order to make the necessary decisions. But it's certainly a far less effective mechanism. Really to be effective, an agency will need examination authority, rulemaking authority, and enforcement authority.
I completely agree. I just add one thing. Under the House-passed legislation, if the prudential regulator isn't doing the job on consumer compliance regarding the rules of the agency, it's a very cumbersome, almost impossible task for the consumer regulator to get that authority back. So that's also a problem.
Okay. We have time for a couple more questions. So in the front row here.
Two questions. Travis and Julia, both very bright people. Be bright enough to name one alternative for consumer protection that is better than the status quo, but is not as good as the CFPA. Name one alternative that's better than what we have now, but not as good as CFPA.
Well, I'll give you one, but I won't tell you that it's politically viable. We've proposed it in the past, and that is to consider shifting more authority to the one existing agency that has some financial oversight power right now. That's the Federal Trade Commission. Give them more authority over not just the non-banks, which they have now, but banks as well. We proposed that with a bunch of groups in 2007. Not viable at all politically because of jurisdictional concerns by the committees. Also, there are problems with that approach. The FTC now regulates, thousands and thousands of consumer products. They've been starved for resources. They don't have an independent source of funding through industry. They're complaint-driven, as they have to be, given how much they regulate. And the antitrust part of the FTC has been dominant, not the consumer protection part, for so many years. But that's an approach. Same theory. Need an independent regulator. Need it focused solely on consumer protection. That's worth talking about. I don't see it happening in Congress, though.
Well, I'll add a couple of other approaches that also have their own political problems and in many ways don't offer some of the advantages the CFPA does. First of all, one of them is substantive legislation to protect consumers by the Congress. What's interesting to me about the debate over CFPA is the same voices on the Hill with whom we've been arguing for years over the need for substantive regulation of things like mortgage origination or bank overdraft programs. They have heartily opposed those. Now that there's a agency in the offing, you will hear all of the lobbyists say, well, of course we need substantive regulation. So, in the event that there is not, that we don't emerge from the current situation with additional protection for consumers, that bluff needs to be called and Congress needs to act substantively. A second approach, again, not quite the same thing, but I think that would be incredibly helpful for stopping problems before they get so large that we can't clean up after them, is to roll back OCC preemption and let the states do their job to protect their citizens.
Yeah. And that's a good setup for our next panel. I actually wanted to ask Tim something about his public option kind of analogy and push you a little bit on that. And do you see this as being the case with not enough sufficient work has gone into defining this alternative concept for a campaign? Was that your point? Or that this is kind of, in the best possible world, something we'd like to have, but it's never going to fly?
I think I compare it to the public option in that it's something that people can understand who are following financial reform for maybe the first time. Talking about derivatives going over the counter and whether or not they're going to be exchange traded is a little advanced, but everybody more or less has gotten a mortgage loan or a car loan or suffered under overdraft fees. So in that sense, it really should be something that's politically popular if you're telling people, look, your bank is not going to be able to raise your interest rates without telling you and things like that. I think it has been very clearly defined. It's frankly a simple concept of this agency that I think everyone in the room understands and people have been working on for years. But I think what is missing that was there in the public option debate for a certain amount of time is sort of a broad-based sort of, I don't want to say movement, but during the Democratic presidential primaries in 2008, we saw people talking about the public option. Healthcare reform is something people have talked about. It's been a major plank of campaigns for years, but I don't think financial regulatory reform has had that same broad public attention. And that's what's allowed the financial sector to come in and say, this is a bailout program, they're going to take away your choice, the government is going to tell you what kind of loan you can get. And while none of those things are true, there's not been a big voice saying that none of those things are true in the public debate. And the money the financial sector has to amplify their voice has drowned out what are pretty realistic observations by people like Julia and Travis, that it's made it very easy for people like Tim Johnson, who's a Democrat who's going to be the next chair of the banking committee in the Senate, to not support what ought to be politically popular legislation.
Thank you. All right. Thank you, Travis, Julia, and Tim, for your contributions today. We can all give them a quick round of applause. And